Imagine a product so powerful it prints profit without making anything you can touch. So invisible you buy it every day without noticing. That product is debt. Debt has financed wars, toppled empires, disciplined nations, and quietly siphoned the savings of ordinary people. Ask where it came from, who shaped it, and why it rules our economy. And most people shrug. But the story of debt isn't bookkeeping. It's the story of money and power. Debt, at its core, is a promise. Borrow today, pay tomorrow. Inside that promise sits the lever of control interest. Charge interest and the future becomes a revenue stream. Ancient Mesopotamians tracked debts on clay tablets and periodically wiped them clean in debt jubilees. Leaders understood a simple truth. When too many people are trapped by obligations, the system stalls. The Hebrew Bible formalized it every 50 years, a jubilee. Debt was dangerous. Left unchecked, it could enslave entire populations. But as the centuries rolled on, elites learned a different lesson. Don't erase debt, weaponize it. Medieval canon law restricted usury, but merchants and early bankers engineered around the rules. Loans were disguised as trade deals. Bills of exchange moved value without calling it interest. By the Renaissance, houses like the Medici built power not on fields or armies, but on lending. They financed kings and popes. In return, they got money and leverage. Debt evolved from tool to engine of influence. The real revolution came in the 17th century, state debt. The Dutch Republic sold bonds to its own citizens to fund independence. War no longer ended when the treasury's silver ran out. You could finance it by selling the future. England copied the model. In 1694, the Bank of England formalized permanent national debt. The state borrowed. A central bank issued notes backed by that debt. Rollover became routine. Lending to governments became the safest business because governments can tax. Wars extended empires. Empires opened markets. Markets created more debt. A loop profitable, durable, hard to escape. In the 18th and 19th centuries, bond markets in London, Paris, and Amsterdam became the heart of global finance. Armies marched and ships sailed on borrowed money. Then credit seeped into daily life. Railways, factories, bridges, built on loans. Workers earned wages from debt-funded companies and then borrowed to buy homes, tools, later consumer goods. By the 20th century, debt wasn't for princes and tycoons anymore. It was an everyday product. Mortgages, car loans, installment plans, credit cards, student loans. Borrowing became the default setting of modern life. Why is debt so profitable? Because unlike a product you buy once, debt pays again and again. Every interest payment moves money from the many to the few month after month, year after year. A 30-year mortgage can cost 2 or 3 times the sticker price. A rolled credit card balance grows faster than your paycheck. What begins as a promise becomes a trap. No factories, no inventory, just contracts, signatures, and the authority to create money from promises. That's why Amsterdam's merchants, London's bankers, and Wall Street's financiers became architects of the modern order. The system doesn't just manage debt, it manufactures it. After World War II, the Bretton Woods architecture scaled this globally. The IMF and World Bank lent to nations in crisis or development, often with conditions attached. Budgets to cut, assets to privatize, policies to rewrite. The promise was stability. The outcome was often dependency. Economic strategy could be shaped not just in national capitals, but in Washington or Basel. Debt became not only profitable, but a lever of discipline. At the same time, banks discovered how to sell debt straight to households. The mortgage became the crown jewel of middle-class aspiration. Home ownership, once elite, spread to millions, tethered to 30 years of payments. Car loans, furniture installments, credit cards, debt turned into a consumer product marketed like any other. Buy now, pay later. For banks, interest flows compounded across millions of accounts. For governments, credit-fueled consumption masked wage stagnation and flattered GDP. For corporations, future spending could be pulled into the present. Debt became the hidden engine of capitalism, infinitely scalable. No mine, no factory, just paper and later digits. But scale bred addiction. Banks didn't want debts repaid quickly. They wanted them rolled over. Governments learned that borrowing was easier than raising taxes. Politicians could promise benefits today and push the bill onto tomorrow. Central banks, able to create base money, ensured liquidity to keep the wheels spinning. Debt stopped being a bridge. It became the architecture of the system. By the 1970s and 1980s, the consequences were impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily, aided by Western banks recycling petrodollars after the oil shocks. Then rates spiked under Fed Chair Paul Volcker. In 1982, Mexico said it couldn't pay. The solution? More loans under stricter terms. Borrow to survive, borrow to repay. With each turn, countries lost policy control. Citizens faced austerity and inflation. Creditors collected interest. Meanwhile, the rich world learned to package debt. Mortgages, auto loans, corporate IOUs bundled into securities and sold worldwide. Debt ceased to be a private pact. It became a tradable commodity. Fees at origination, fees at sale, fees at servicing. Risk was declared distributed. In truth, it was hidden until 2008 exposed it. When the premise snapped, homeowners won't default en masse, the system shook. Banks were rescued, families were not. And afterwards, debt grew bigger. The crisis caused by leverage became the justification for more leverage. Zero rates, quantitative easing, liquidity waves. By the 2010s, debt wasn't just profitable, it was indispensable. Governments financed deficits, corporations borrowed to buy back stock, households borrowed to maintain living standards. Without constant borrowing, the machine would stall. Global debt climbed past 300 trillion, more than 3 times world GDP. Much of what we call growth is simply tomorrow's income pulled into today. Debt also concentrates wealth. Those with assets borrow cheaply to buy more, leveraging wealth into more wealth. Those without assets borrow expensively, trapped in repayment. Every month, interest flows uphill from millions of paychecks to the largest balance sheets on earth. Debt is not just a product. It is a marketplace where promises are priced, traded, and harvested. And a new layer is coming: programmable money. Central bank digital currencies could make loans and rules code-native approval by algorithm, rates tweaked in real time, penalties enforced instantly. Efficient? Maybe. But history suggests efficiency for the creditor often means less freedom for the debtor. The most profitable product in history is being upgraded again, far from the public eye. So, what should we learn? First, debt is not neutral. It's not a natural feature of modern life or a harmless tool for progress. It's a deliberately cultivated business model that turns time into money, channeling the hopes of individuals and the budgets of nations into streams of interest payments flowing upward. Second, inflation is often policy, not accident. It's the quiet tax that makes repayment possible, trimming the value of your cash while preserving the nominal power of the debt system. Third, resilience means minimizing dependence on borrowing. Question easy credit. Run the numbers. Understand compounding, both how it grows savings and how it multiplies obligations. Real wealth is built on productive assets, skills, and margin for error, not on a stack of promises to your future self. From clay tablets in Mesopotamia to suburban mortgages, from Dutch bonds to Wall Street derivatives, the pattern repeats. Creditors are enriched, debtors are burdened, and power follows the flow of interest. The cruelest trick is that we're taught to celebrate it, to call it progress, to mistake borrowing for prosperity. If this sharpened your lens, subscribe. History doesn't repeat, but it rhymes, and it shows you exactly where to look next.